Welcome to the Daily Update, where I'll go over the action in the market for Monday, November 3rd, and we'll see how things look for Tuesday, November 4th. Okay, we're still seeing some internal weakness starting to build. The mega caps are still pretty much holding the market together. They had a pretty good day there, and if it wasn't for them, we would be seeing more weakness. Even though the mega caps did okay, the broader market is drifting. And even though we're coming into this period of positive seasonality, we have to wonder, okay, is the market going to throw enough of a curveball here to at least doubt that will happen before we really do possibly experience some positive seasonality? And we're still looking at some setups that are making the market look a little bit more vulnerable. Now, as I keep saying pretty much in every video, a solid day or two could take care of all that, but we're just not getting that right now. And so we're seeing a drifting that's going more over to the negative side right now, but we're still positive across all the time frames. Okay, before I get into this, please know I have a thing called the SPX investing program. It's free until the end of 2025. The video, like this video right here, you don't get access to it on YouTube or Rumble until the market closes. If you go to the website, and you have to sign up, and unfortunately, you also have to provide some payment information, even though nothing is charged to you. There's also another site in the link below where you don't have to supply anything. You just go ahead and subscribe there, but then you don't have access to everything that I post. So there's a bit of a give and take there. But check that out and just see if it's something that is useful to you. Okay, so right at the open, we had a higher open. This is shades of Friday. We set the open, or we set the high right at the open. We were above R1, 68.75. That set the high, and it was just a little bit above Friday's intraday high. Then we started to decline pretty much right out of the gate. We went below R1. We went below the daily pivot at 68.45, and then we actually dropped negative below the unchanged level. We found support at the 68.25 level, right around that level there. Then we saw a pretty nice rebound. We rebounded back up to Friday's resistance at 68.62. That's why I show more than one day on the chart, and sometimes previous pivot points may also act as support or resistance in the current day. Then we declined. Going into the close, we closed right around the 68.50 level. We were up 0.17%. We're still not trending right now, and you can see that we're not really moving up or down all that much, at least to this point. And we are above average with volume. We're drifting a little bit. We're not as far above average as we were at days during some of the days last week, but we're still above average overall. We're still positive on all three time frames. We haven't even come down and really tested the 20 period moving averages. That's the short term. And then we're still positive in the intermediate and long term. There was some trade news that came out, but it didn't really seem to have much of an impact on the market because most of this was already baked into what the market is thinking is going on there. The government shutdown is still continuing. Of course, you have each side pointing fingers at the other and trying to twist things to favor their particular view on things. And so it was kind of a sleepy day in that regard. So, some comments. Mega caps did outperform while the broader market was weaker. And Lisa Cook, you probably have heard this name in the news for other reasons. Apparently, was it a month or so ago? She was fired by President Trump, and then, no, you can't fire me, and that's all being worked out in one area. Well, she came out and made a statement as it applies to the markets here. I don't really deal on the firing, not firing issue. It's just like, okay, how does this impact the stock market? She pretty much said what we've heard from other Fed officials about the uncertainty around the Fed's next move, saying policy is not on a predetermined path. Okay, there you go. And then Fed President Mary Daly, who's not a voting member, said that the Fed should be open-minded about cutting rates in December. It was a little more dovish to the market, where most of what we've been hearing, going back to Jerome Powell last week, has been more hawkish about the December rate cut. Then the U.S.-China trade deal, it didn't deliver any surprises. The overall tariff rate on Chinese imports was lowered to 10%, and the 100% additional tariff increase will be postponed for a year. A negotiating tactic that's going on here. And so they got together, they worked some things out, and it's a bit more favorable in that regard. But the market reacted to this a week ago, so this isn't really anything new. We do have a confirmed Hindenburg Omen. No additional spike. There's a 1 day delay on the chart, so no spike on Friday. We'll have to see if we get any more. But this has been confirmed now, and that's a negative thing. So we're just gonna watch and see how things unfold. And we only have the stochastics that are showing any kind of positive momentum right now, and even they're starting to show some weakness. Nothing in the intermediate term other than the boom indicator. We're still far away from the 50-period moving average. And then no change to the overall scenario. It was adjusted last week, where the Fed is still anticipating that we will not go into a recession. In fact, we're not getting GDP, but the Atlanta GDP now forecast is still pretty solid, up around 4% or so. And the rate cut in December is not as likely as previously thought. That's what spooked the markets last week. The dollar was up, which could also be pressuring stocks. We're getting near that 100 level with the US dollar index. Interest rates did tick up. We were just a week ago below 4%. Now we're up to 4.11%. After Friday, we were at 4.1%. Not a big change there. And sentiment is improving. So we're still negative when you look at the number by itself. We have to click above 45 to get back to neutral. So 44 is still negative, but improving from a reading of 35. We're still not trending either in the short or intermediate term. And if you watch the weekly video, we're starting to see a trend on the weekly chart, but it's not above 20 yet. It's not a confirmed trend. But when you look at the short and intermediate term here on the daily side and then the weekly chart, the green line is still above the red line on all three charts. So we're still defaulting more to positive, and that hasn't changed at least yet. And then I kept the bias at mixed because, yeah, we had a bit of an update, but there's some internal weakness that's continuing. And then momentum, I'm also keeping it mixed because we're seeing some areas that are holding up okay, other areas that are starting to show some weakness. All right, and then we did get the ISM manufacturing under 50. That's kind of the takeaway here. It came in at 48.7. When it's below 50, it shows contraction in manufacturing. When it's above 50, that shows expansion and weaker than they expected. They thought it would come in at 49.4. Last time it was at 49.1. And then this one, I have a chart of the ISM manufacturing, but the next one, the S&P Global US manufacturing, I just go over the number here. The takeaway is that we're above 50, and last time it was at 52. The latest reading is at 52.5. A little bit of an expansion there. So here are the charts of the ISM, and we have the blue line, which is the total. That's the headline number there, just going up a little bit here, but still below 50, where the orders are actually coming down a bit. It could show a bit of economic weakness, but we're just seeing this kind of chopping around, really no conviction in the chart. And then we look at prices and deliveries, where the blue line prices are coming down. That's not inflationary. Deliveries are actually going up. That shows a more solid manufacturing part of the economy. And then imports and exports, both are going down. The yellow line, those are imports. The blue line, those are exports. Both are declining. And a lot of this has to do with the tariffs and trade deals and so forth. And then here is the reading. The dashed line right here, that is the 50 level. And we've been below 50 now for most of 2025, showing contraction in those areas. All right, and then here is put out by Carson. This is from Isabel Net blog charts. So much for sell in May and go away. Well, we kind of addressed this back last spring, but they just wanted to bring it up again. Because if you watch any of the weekly videos that I do on a seasonal basis, right now, we're in the strongest period of the year. The second strongest period of the year is July. Well, if you know your calendar, July comes after May because there's this cliche, sell in May and go away, because usually there's the summer doldrums that happen. That hasn't been really true in recent history. And so they're just bringing up different statistics going back to 1954 and then the November to April return, which is the strongest time of year for the stock market. And we're pretty much seeing really good things, except 2024. We ended up being down there, and we don't know how 2025 is going to come out. But a 90% success rate during this time on a seasonal basis, and a 13.5 to 13.9 return during that time. And then equity positioning, this isn't price, this is how many people are in stocks right now. It had been dropping back down, now it's starting to go back up and it's above zero. And then the market cap and earnings of the 10 largest companies that make up the S&P, market cap is 42%, earnings account for about 30%. And then here's the discretionary investors. This is when you try to say, okay, it's a good time to buy stocks. It's not a good time to buy stocks. I'm going to buy, I'm going to sell. And how this has been, folks have been positioning, and they're still a little bit net long right here. And if you want to pause this and go back and look at other events that have happened, and then what happened after that with folks that take more of an active approach in the markets. And then this is what we see pretty much every day. The market's overvalued. We look at the S&P coming in at 23. Again, if you watch many of my videos, I tend to discount the Russell 2000 because it's a different index. I use the S&P 600, which lines up more with the S&P 400, the mid caps, and the S&P 500, the large caps. So yeah, this is coming in at 24. But if you look at the S&P 600, we're down around the 15 to 16 level, which would be more fairly priced. And then the growth area of the market, the NASDAQ 100, that's coming in at 30 times earnings. So we're above that 20 level. And then the equal weight, more fairly priced, a little above the 15 level, but below the 20 level there. Then here's another look at discretionary and systematic investing. And seeing some money going back in now. And the blue line, that's systematic, where you just follow a system and you don't really pay attention in a very generic sense. You don't really pay attention to the market. You might dollar cost average and say, okay, we're going down now. So my dollars are buying more shares right now. Where the blue line, or excuse me, the green line here, that is trying to determine when it's good, when it's a bad time to get in. When the market's been really strong, like it has been recently, the blue line outperforms the green line. But when we're going down, the green line tends to hold up better because you got people getting out of the market at that point. And then here, CapEx spending estimates for AI, hyperscalers. This is the big area right now. And of course, the debate's going back and forth. Is that a bubble or not? There are some areas, yeah, you could probably justify, new companies that nobody really knows much about that have been created just for AI purposes. But then the more established companies, they have the money behind them to spend on AI and also the earnings to back that up as well. And this just shows how it's really going up right now as far as here's Amazon, Google, Meta, Microsoft, Oracle, just a lot of money going into those areas. And then we've seen this chart 3 or 4 times now. This is Goldman Sachs doing their projections. Again, I don't project, but people love that even when they're wrong. It's like listening to the weather. But they think that we're going to be at 7,200 with the S&P a year from now, and then earnings are also going to go up. Then this is a thing called SLOOS. While lending standards tightened for commercial and industrial loans to firms of all sizes, the Senior Loan Officer Opinion Survey, SLOOS, gotta love that, reported strongest demand from large and middle market firms. Okay, and I don't like this since 2022. It's like, fine. What was the context at that time? So we're seeing some more demand coming in here, and that could be good for the economy. They're looking to expand and add some things there. Then bubble watch here. There's a lot of talk, a bubble talk out there, but in my view, apparently this is Timur Fidelity. That's their view. It's still early here. Below this, there is a lot of comparison between 1998 to 2000, and I went through that time. I started in the markets in the early to mid 90s, so I saw the whole run up during the dot-com boom and bust, and they're trying to do an apples to apples comparison between what's happening now in AI and what happened back in the late 90s. And the only real comparison is that we're going up. Okay. And there probably are bubble areas in the market. That pretty much happens all the time. There are companies that overdo it. They can't really come through with what is expected of them. But back in the late 90s, you had companies that just were .com. That's why they were $300 a share. No earnings. Some of them didn't even have a building yet. They were in boxes, uncorking champagne bottles when their stock went public, and you had these instant millionaires for about 3, 6 months or so, and then they all had to go back to their old jobs after all that stuff was wiped out. I mean, we can make fun of that, but a lot of people's lives got really messed up by all of that happening. But it says, so if you look at the chart, this is the conclusion coming here. When you compare 1998 to 2000 with what's happening now, an analog of Cisco. This is the router company in Silicon Valley, San Francisco. And back then, overlaid on the valuation of NVIDIA today. See that they're trying to make a comparison. Cisco was the big company at that time. Those are the then and now poster children of internet and AI booms. As you see, we are nowhere close to the kinds of silly season valuation that we saw back in 2000. So there's still more room to run according to this chart. Okay, and then beat and miss companies that come in and beat their earnings estimates, they tend to be rewarded by the stock going up. If they miss, look out below. They've been getting hit pretty hard. And then profitability adjusted valuation. This is, again, looking at valuation here, the forward PE ratio, pretty lofty here, just a little bit under 23. The profit margins, though, continue to go up. And here's another adjusted PE ratio going forward, and also looking at forward profit margins this way. So when you see now the earnings, that's a little bit, or the PE ratio is a little bit concerning. But when we're seeing these other couple of charts still going up, that tends to be more profit or more positive for the market there. Okay, so here is the chart. And you can see on Friday we gapped up and set the high right at the open and then just kind of drifted. Very similar approach in Monday's session. The futures were quite strong. We did get a positive open, but if you were watching this, we set the high right at the open and then just started coming down. We fell down below the daily pivot. We went negative. We did find support at 68.25. Then this was pretty impressive. Coming back, got above the unchanged level of the daily pivot, and we topped out just at about, you can see this faint dashed line. This is a pivot point from Friday. And this was R1 in Friday's session, and that's just about where we topped out in Monday's session. And then we drifted down going into the close. We were positive, but we gave up some of the gains that they were trying to get back earlier in the session. And then we're down a little bit in the initial overnight session here. There was a bit of a gap up Sunday evening with the futures, and they were looking pretty good. But then once we got into the cash session, that's when we saw selling taking place. And still looking okay here. The blue line's above the red line. We take the context going back to the latter part of August, where this is tending to go up here. Not showing an awful lot of strength right now, but not really rolling over either. And this is also still looking okay. The intraday growth to value chart for the S&P. We're still above all the moving, well, not quite. The short-term moving average, we pulled back there, but we're showing that growth is outperforming value largely after we finally had broken out of this sideways channel that we had been in. But again, we go back to the beginning of September and we came up and then went range bound, and now we are still looking more positive again. So this is still looking okay here, where growth was up, value was down. For the mid caps, growth ended up being down where value was up. And for the small caps, growth was up more than value. So we're still seeing a really good looking chart here. We just can't seem to get much of an action much reaction in the index itself. And this looks better here. We actually closed at the high. The small caps were seeing some weakness and then ended up being up on the day. And the growth to value ratio, that's looking really good. Recent golden cross here, but we need to see more follow through with the index itself. Still holding up okay above the 50-period moving average with mid-cap growth to value, and still below the 50-period moving average with S&P growth to value. This is one of the areas that's giving us a bit of concern right now. It's not falling apart, but it's not showing any real convicted strength either. But this is looking okay. This growth to value ratio actually broke out on a bit here to get to a new all-time high with this ratio. And we're still hanging out around the 50-day moving average with discretionary to staples. So not showing any real strength, but not showing any weakness either currently. And then as far as the trend, this is short term. We're still, the ADX, that's the black line, still going down below 20. We're below the moving average. We're not trending in the short term, excuse me. And we're also not trending in the intermediate term, below the moving average, below 20. But we're still positive with the green line above the red line. And volume has been fairly healthy here. It's dropping off a little bit, but still above average. Now, once a week, we get this sentiment gauge. We're down here in the more negative area with the daily chart that we look at. This is a composite of a bunch of things together, and we only see this once a week. This is still coming in showing that sentiment is still quite positive overall at 78.51. And another sentiment gauge that is actually negative, but showing signs of improvement after, well, it had gone above zero and now it's starting to fall back. This is put out by Goldman Sachs. And then we look at gamma exposure using some of the option Greeks to try to determine support or resistance. The first takeaway from this chart is that it's all green, and that's positive. When we start seeing red areas pop up, that's the market turning more negative. Then we look for these yellow, yellow, my goodness, blue columns. And then where do they intersect the blue line going here? And 6,900, that is overhead resistance right now based on gamma exposure. So, and then where we see these spikes, which tend to be at round numbers, and you notice we've been hitting a lot of round numbers lately. These also line up with strike prices because that's where option strike prices are at. But if we do start to go up, we're at 68.52 if you round that up. So if we do see some upward moves here, we might hit some resistance at 6,900 according to that chart. And then bullish option sentiment. The number of stocks in the S&P top 100 trading inverted call skew. I look at the skew index here, a sign of extremely bullish sentiment where the out of the money call trades at a higher volume than at the money call. Okay, it's surged to about 20%. This just means there's still a lot of speculation that we're going to go up from here. There's a lot of folks that are just assuming that we're going to have positive seasonality, and instead of going out and buying all the stock or buying the index, they buy call options, which require a lot less capital to do that. And so we've been seeing a bit of a surge up here in sentiment, just thinking that the market's going to go up. But they're not totally sure, so they're going to use call options instead of buying everything outright itself. Okay, and we're still below 20 with the VIX, with the line chart and the bar chart. And we haven't really stuck to seasonal patterns with the VIX now. So we'll see how we're just not really sticking to it these days. And we're a little above the moving average with the VIX of the VIX. This is the volatility of the VIX itself. We're above the moving averages with the bar chart. We did decline, but we're coming right up to the top end of the moving average with the line chart. Okay, man, we saw a big spike here. When this goes up, that means fear is coming back into the market. And we just kind of went up a little bit. Not much of a change with this fear gauge. So we're seeing some confirmation in this chart of fear coming back in. A little bit more fear coming in. We're seeing the daily equity put call chart going up. And we're going back up with the 5-day chart. Now, we were getting a very low reading here, and a lot of times that can mark a market top. We'll have to see if this continues to go up. But this is an extreme positive sentiment reading when this chart is very low. But we're ticking back up after getting a very low reading here with the 10-day chart as well. So when you look at these, that's also showing that the market might become a bit more vulnerable. But we're not seeing that here. We're below the band here with volatility risk premium. So other fear gauges that we look at are showing a pickup in fear. This chart is not showing that. All right, and we're coming down a little bit with the advanced decline line based on price, but in the bigger picture, still positive. And we're pretty much flat here based on volume. So for right now, volume is holding up a little bit better than price, which could be positive. But we're below zero with the short and intermediate term advanced decline ratio. We're dropping below zero with the advanced decline oscillator. See, this is the weakness that I keep talking about here. And then internally, we're seeing a drop off in the new highs, a bit of a contraction of the new lows, but when you measure them together, we're still going down with the 5-day moving average chart and the 10-day moving average chart. So that's showing some internal weakness as well. We're still negative in the short term with accumulation distribution. Coming down to the moving average here, that's positive in the bigger picture. Shorter term, we're below the moving average. And we're still negative with smart money indicator number 2, Chaikin money flow, and we continue to decline with smart money indicator number 3, Chaikin oscillator. But this is still showing some strength here. The green line for the vortex continues to go up and the red line is going down. So we're finally starting to see these two lines separate more from each other, where they were jumbling up all over the place there for a while. And seeing some weakness here. We're still below the moving average when we look at our advanced decline line studies, and then the NYSE common stock starting to drop a little bit below the moving average. Now, this is a different moving average than what I showed before. That's longer term. This is more shorter term. So seeing a bit of a pull down here. We're below the moving average with the mid caps and the small caps. And we're below 50 and declining with those stocks in the S&P above their 20 period moving averages, 50 period moving averages, 100 period moving averages, and 200, even though this is positive since we're still above 50. And we did hit this overhead pivot point here. That's about where we topped out last week. And we haven't been able to get back up to this level here. And we're looking a little bit more vulnerable with the price action of the market. And I'll point that out as I go through some charts here. You can see how we're just kind of chopping along sideways right now. But we did see a bit of a decline with the 20, 50, and 200-day moving averages on the S&P. We're above the midpoint with the Stochk RSI, but we want this to be pegged up near the top, showing positive short-term conviction. And just below, showing positive short-term conviction with the Williams percent R. And we're actually declining with the CCI 14 and the CCI 20 charts. Now, when we're really seeing positive conviction, all of these charts will be extreme, and none of them are right now. We did tick up a little bit, but we're still below the moving average with the short-term stochastic. We're going down in the intermediate short term. That's still more negative. We're rolling over and starting to turn negative with the long short term, but we're still getting an extreme positive reading. And we're still positive and hanging out right about at the midpoint with the force index. Still looking good from a moving average perspective, though. We're above the 10, 20, and 30 period moving averages here. And the short-term trend is still holding up for right now. And we're above all the plotted moving averages, but we're more than 10% away from the 200-day simple moving average. We're now at 12.03%. And when we get too far overextended, that has typically led to more substantial declines. That's another vulnerability that we've been watching now for quite some time. And we're not too far away from the 20 period moving average, but we're still getting a reading above 200 here when we measure the distance above the 50 period moving average. So we're a bit overextended in that area. And we're still barely in the +2 channel with the standard deviations chart. Now we switch over to intermediate term. We are seeing some weakness coming in here with the balance of power, although it's still above zero. And this is why I don't like these charts here. This redrew after Monday's session and went back and changed Friday's bar to more negative, where over the weekend this was still a darker blue. I don't like charts that do that. Tell you what you should have done when time has already passed by. And we're still hanging out above the midpoint with the highest high, lowest low value chart. The long-term trend here with the Landry light, still 129 trading days, and we're on day 7 after we took a bit of a pause with the proper order, but that's in an uptrend. The TTM squeeze is still positive and going up. And we're coming down, but we're still above the moving average with standard deviation. It's picking up because it goes over the last 10 periods. These gaps that we saw here just sent the standard deviation through the roof. And it measures speed, not direction. And then as we go on day after day after day, and we don't go anywhere, if that's what continues to happen, the standard deviation will eventually drop down below the moving average. And we're slightly positive here with the ease of movement. We're still positive with the Arun. We focus on the oscillator down here. It's above zero, even though it's flattening out. And we're still looking more negative with the S&P McClellan oscillator. That's going down here, showing some internal vulnerabilities in the S&P. And when that's negative, we're going down with the summation index based on price and volume. Also below zero with the NYSE McClellan oscillator. So that's another broad market sign of some weakness coming in here. And we're still declining with the summation index based on price and volume for the NYSE. Swindling trading oscillator declining based on price and volume. And rolling over a bit here, but still positive with the momentum with the PMO. But we're dropping further below the moving average when we break it out based on price. And now we're starting to cross below the moving average based on volume. Again, some vulnerabilities inside the S&P. So we're still seeing below 50 readings with the PMOs that are rising. The buy signals are going back down, and we're also drifting lower with the PMOs in the S&P above zero. And we're neutral with the Elder's Impulse system, but positive still with the parabolic SAR. Still positive from a momentum standpoint. The slope oscillator is above its moving average. That continues to go up, and we're above this green line, which you could suggest is an extreme reading. But we're rolling over a little bit, but still above the moving average with the MACD. So the short term, still going up with the slope oscillators I showed a moment ago, but we're pretty much flat with the other short-term oscillator, the TSI. Seeing a bit of a rollover here with our three intermediate term oscillators. The long-term oscillators continue to be positive, and we're positive with the Copic curve. We're also flat and still looking positive overall with the Sean trend meter, but it has been coming down from an extreme positive reading. Still above 50 with the money flow, declining but above 50 with the ultimate oscillator. Still above the moving average with unbalanced volume. Still just, this actually doesn't need to be on here. After getting an extreme reading, we now are not getting an extreme reading with the percent B indicator since we're not closing above the upper Bollinger Band right now. And the RSI is still holding up in the intermediate term and the short term here. We're above 50. But now we're turning more negative with the bullish percent index. This means that the number of sell signals inside the S&P is starting to increase. And that's not showing internal strength. That's showing more internal weakness. And we're declining, but still above 50 with the NYSE bullish percent index. And we're flat after we had spent a couple of days declining with the NASDAQ 100 bullish percent index. Still looking good, hanging out above the lines here with the trend condition based on 50 periods, which is intermediate term. And we're still working off of a mass index reversal signal. We were going up, which made the criteria be met. And so this would be predicting that we're going to have a decline, where we're still on a buy signal from the Pring bottom fisher. And this is still looking pretty good here right now. These are weekly bars, and we're still seeing a series of higher highs and higher lows for the most part. We're below this R2 pivot point, but still well above this other R1 pivot point. So seeing a lot of doji-like candles here with the Heiken Ashi, that just shows indecisive price movement. And we're positive but pointing down with the Kegi chart. It's positive when it's black. It's leaning more negative when it's going down. But we're still positive with the Renko chart and the three-line break chart. Long term, we're seeing a bit of weakness here with the 150 and 200 moving average study. We did tick up a bit with the 150, but we're declining slightly here with the 200. And still negative in the short term with with the mid caps here. And I'll get over to bonds here in just a moment, where all of the other indexes continue to be positive on all time frames. These are bonds in the short term are negative, where we're looking at a bit of strength here in the short and intermediate term with the dollar, and that could pressure stocks if it continues to go up. So we had discretionary. That was the strongest area, and even that was up less than 1%. And then tech, that's another growth area as well. And then we had communication. It was the worst performing area here. So two of the growth areas really helped things out. One growth area did not. And we also saw a continued weakness in staples. So a lot of red here, and then we had the Nasdaq bouncing back up above 23.8, 23.9. But before that, right after the open, we had a BPI cross below 30 with the materials, which have been getting hammered a lot lately. Then we had a BPI cross below, that's what I showed earlier on, below 50 with the S&P itself. And then industrials have had a bearish MACD crossover. So some technical damage done on Monday. And then a lot of green here in the communication area. That held up okay, but then Meta is just getting hammered here. And then Nvidia, that's another one that really kept things up a lot stronger. So then the Dow just kind of humming along. It was down almost 0.5%, still positive, but not showing a lot of conviction. The diamonds are still neutral and still having a difficult time getting above this overhead resistance with the Nasdaq. It was up almost 0.5%, but still neutral with the Elder's Impulse system. Nasdaq 100 also hanging out around this pivot point and neutral with the Elder's Impulse system. Still hanging on to being positive with the momentum for the Nasdaq 100. Then we have small caps. They were actually up 0.21%. Just kind of, it's hard to see because these new pivot points are coming in now. But we're just hanging around the 50-day moving average with the S&P 600. It's hanging out a little bit above the moving average with the Russell 2000 small caps. and still negative though with the Elder's Impulse system. Mid caps below their 50-day moving average, having a difficult time breaking above the new pivot point for November, and also negative with the Elder's Impulse system. The Wilshire virtually unchanged on the day, but it's holding up, as is the total U.S. stock ETF. Financial sector continuing to show some weakness, drifting down a little bit below its 50-day moving average, and continuing to see this ratio going down that I've been just hammering on for months now. But we don't really know why this is happening. We just see that the market is reacting to this on a consistent basis. And then the FANG index was up 1/3%, not really moving out, but doing a lot of sideways chop. So Apple was down almost 0.5%, and then we had Amazon, which was up 4%. They're doing really well these days. There were some AI cloud announcements that kind of kept the mega caps in positive in Monday's session. And then Microsoft, it was virtually unchanged, hanging out around its 50-day moving average. Google up 0.9% here. That's been pretty strong lately. And then Meta, in that market carpet chart was not correct. We're drifting further below the 200-day moving average with Meta. And they came out with a good earnings report. It's just like, we're going to spend all this money for AI. And the stock market hasn't liked that. And Nvidia up over 2%, looking pretty solid there. And Tesla up 2.59%, finally possibly breaking out of this range that it's been in. Where Netflix continues to drop further below its 200-day moving average. We're still going down for the most part when we look at the staples to tech ratio, and that's positive for the market. And we're still going up when we look at the semi to tech ratio. That's also positive for the market. And coming down here with the gold to S&P ratio after we had hit some overhead resistance here, and still seeing a bit of a drop off in the short term, but it's still maintaining things longer term when we look at the relationship or correlation between US and world stocks. And came up a little bit into the 61 range with oil, and this is the dollar. We're right at 99.99. So if we break above 100 and start to really go above that with some more dollar strength, that might put some pressure on stocks. Stocks like a weaker dollar. All right, and then we're coming up above this 4% level here. Not very much in Monday's session, but we just a week ago we're under 4%. Now we're back above the 4.11% level and declining a bit here with the 10-year based on price. And still looking good with the Qs to S&P. This is quite positive. That's what's keeping things holding up for right now. A little bit of an improvement here with discretionary to the S&P where it's coming back above the moving average. And large cap growth is outperforming large cap value. That's holding up fairly well there. So the large caps are looking pretty good, coming back up to the moving average with the mid caps and really doing well with the small caps. We just haven't seen much follow through in small cap price action at the index level. We're still going down here with the staples S&P ratio, which tends to be positive. So there is still a real positive backdrop, but you see some of our internal indicators on the S&P, they're showing some vulnerabilities for the S&P, which leads us to believe that, okay, we have a solid update, could take care of all of that. If we do see more of a decline, other parts of the market seem to be holding up, and right now, anyway, it looks like it would just be a decline, a normal decline, with folks doing some profit taking, not really shifting its overall nature from positive over to negative. And then here is the Hindenburg Omen, the latest. We did get another spike. There's a 1-day lag with this chart, so this was now updated as of Friday. We had the initial spike, and now we've seen confirmation there. And we pay attention to this, and the more clusters that we see, the more we should probably pay attention to it. And actually, one of the perma-bear folks that I kind of follow on a loose basis, they're like, well, you know, 'cause that's really, I think, where I learned about the Hindenburg Omen from. And they're like, even if we're close to a reading, they're like, oh, look out, baby, here we go. Well, they're a little apprehensive now, which for me, I tend to do the opposite of whatever they say. And if they're a little apprehensive, I'm like, okay, we need to pay more attention to this and see if it's telling us something. Because we did see a series of spikes right before the COVID crash and right at the end of 2021. Now, the more spikes we get here, the more we might see some vulnerabilities to the S&P itself. All right, so our outlook, we're still positive across all three time frames. Now we're supposed to get the JOLTS job openings. Now that's not a government report. So, and somewhere I saw that they're going to start doing a weekly version because we only get this once a month. But now they might start putting out weekly numbers as well because it's like, okay, we're not getting anything right now. This might be a good opportunity for that to happen. The trade balance, which we'll have to see if we get that. Factory orders, we'll have to see if we get that because the government shutdown continues. And then we'll see if anything really it's about trade deals when it applies to the stock market, even though there's lots of geopolitical things going on. And then here's what the economic calendar is supposed to be. We're supposed to get the employment report on Friday, ISM services on Wednesday. Now we did get the manufacturing, so we might get that in Wednesday's session. But the initial and continuing claims, that's why we're looking at the JOLTS job openings now, because we're not getting anything from the government currently. And here's also another look at what supposed to be coming out from the economic side of things. All right, and then we're positive from a seasonal basis for November 4th, going back to 2002. So yeah, for Dow, S&P, and Nasdaq, looking fairly solid there. Also seeing some positive seasonality when we just break it out based on post-election years. And this is what a lot of folks are just assuming is going to happen, which may be why it hasn't really started to happen yet. And then November, both the first half and second half tend to perform quite well. This also shows positive seasonality going into the end of the year. This is a newer chart. This is how does the market react after the Fed makes a cut, which they did last week. Sometimes we kind of chop along sideways, but typically we will end up drifting higher overall. This also shows positive seasonality going into the end of the year. Also, another chart. See, I pull these from a lot of different areas, and we're not the only people that look at this. There's a lot of people who go, well, this is the strongest time. And there's money managers out there like, now is a good time to get in. Well, when you start to assume that the market's going to do something, a lot of times things have a way of playing out in a different way. This also shows positive seasonality, no matter how you slice and dice the statistics for November, they tend to be pretty strong there. And we are seeing more of a drop off here with those companies that are coming off of blackout and they can start announcing share buybacks. It's still pretty high, but it topped out right about the middle of October and it's been drifting down ever since. All right, and we're still looking at three smart money indicators that are looking more negative than positive currently, as well as the McClellan oscillator and summation indexes for the S&P and NYSE. Swell trading oscillators negative, as is the bullish percent index, and we do have a confirmed Hindenburg Omen. We just want to watch that these days. And then the mass index is trying to anticipate that there will be a reversal. And then on the positive side, we have still the parabolic SCR, the oscillators for the most part are still positive. And then in the bigger picture, growth to value and discretionary to staples are looking good. It's just over the last few months, we've seen the market turning more defensive, but it hasn't really led to any kind of substantial decline. And the bullish percent indexes for the NASDAQ 100 and NYSE, because they're above 50, even though they're both declining. The ease of movement is positive, as is the money flow, ultimate oscillator, and the vortex. Actually, that's one of the few indicators we have that's showing some improvement. It's the vortex. And then the financial sector is doing okay. It's in an uptrend by itself, but still continuing to underperform the S&P. And then the momentum for the NASDAQ 100 is still positive, as is the long-term special K oscillator that I don't show in this video because we only get maybe one. We didn't get any signals in 2024. All right, and then here are the pivot points for Tuesday's session as well. So the conclusion is we're positive on all the time frames, but there's really no momentum in the short term, and we are seeing some weakness developing, and we're not trending. And we're seeing a very similar thing in the intermediate term, where we're seeing some weakness, like the summation indexes and the swing trading oscillator, a lot of the moving average studies that we look at, and we're not trending that way either. But we're still positive in the long term, but we're about over 12% now on a percentage basis above the 200-day simple moving average. And that doesn't mean we have to stop here. It just means that more substantial declines have generally happened when we get more than 10% above the 200-day simple moving average. Thank you. I hope you have a really good day, and I will talk to you in the next video.